Vocabulary highlighted in the book The Layman's Guide to Understanding Financial Statements by Lawrence Simon J. 1. If you are not able to read and interpret your financial statements, most of the accountants you hire may take advantage of the situation to mismanage the funds. 2. Seal all possible loopholes and ensure that your business grows. 3. Think of accounts receivable as money that belongs to the business but is currently in the hands of another party. 4. The term accounting is only used for established businesses that can sue or be sued. 5. The accounts payable is an entry in the books of accounts that represents the money your business owes creditors such as suppliers. 6. You are running a business. Anything that adds value to your business can be referred to as an asset. 7. Current assets refer to the valuable items that will be converted to cash within 1 year. They include things such as cash, inventory, accounts, receivable, etc. Fixed assets, on the other hand, refers to assets that cannot be converted into cash within a year. Examples of fixed assets include machinery. 8. Group of securities. 9. The main asset classes are equities, fixed income bonds, and cash equivalents. 10. It is a report that summarizes the company's assets, liabilities, and owner's equity within a given time. 11. Working capital is calculated by subtracting current liabilities from current assets. 12. Cash flow statements are prepared within a given period of time. 13. The good news is that you do not have to pass any exams to become an accountant at your business. 14. The cost of goods sold can be arrived at by using different formulas depending on the business model. For instance, the cost of goods sold in the retail business is as simple as the cost of purchasing the goods from the supplier. 15. The word credit, as used in accounting, refers to an entry in the books of accounts that indicates a decrease in assets or an increase in liabilities and equity on a balance sheet. 16. The term debit is the opposite of credit. A debit is an entry into the books of accounting that indicates either an increase in assets or a decrease in liabilities on the balance sheet. 17. A company might choose to invest in different areas from its main operations in a bid to reduce risks. 18. The term expenses is used to refer to the amount of money used on a day-to-day business operations. 19. We have fixed expenses, FE, which refers to payments such as rent that will happen regularly. 20. Variable expenses, V, represent expenditures such as labor that may change over a given period. 21. We have accrued expenses, A, which represent expenses that are yet to be paid. 22. We have operational expenses, which include expenses that are not directly related to the production of goods or services such as taxes, insurance. 23. In the simplest terms possible, equity refers to assets minus liabilities. 24. Company that is insolvent has a negative owner's equity, in that the assets of the company are way lesser than the liabilities. 25. Following the gaps is compulsory for all businesses, but very crucial for publicly traded companies. 26. The General Ledger is an important book of accounting that presents a complete record of the financial transactions of a business over its life. 27. The term liability is used to refer to all the debts a company incurred during business operations. 28. An example of a long-term liability is a long-term mortgage loan. 29. This type of business shields the owners from losing personal properties in case the business becomes insolvent. 30. The net income of a company NI refers to the total earnings over a given trading period calculated by subtracting expenses from total revenue. 31. You will see the money being given now more valuable than the same amount 1 year later. 32. This statement is used to summarize a company's performance by reviewing revenues, expenses, and costs over a given trading period. 33. The ROI is calculated by dividing net profit by the cost of investment. 34. The term IRA is used to refer to a retirement savings plan. 35. In other words, the eligible distributions are tax-free. 36. A bond is a type of debt investment referred to as fixed security. 37. For all bonds, there is an annual interest that is paid. The annual interest paid on top of the bond is what we refer to as a coupon. 38. The money that remains and is retained in the business is referred to as retained earnings. 39. The bookkeeper only comes into the picture to reduce the workload for the accountant. 40. they leave the task of recording transactions to bookkeepers and hand the task of analyzing the financial performance of a business to the accountant. 41. Most startups do not hire bookkeepers or permanent accountants. If you can track down all the transactions yourself, just do simple bookkeeping and only bring in an accountant for payroll and tax processing or consultancy. 42. To ensure accountability and transparency, the bookkeeper is the center of cash flow. All the money coming and going outside the business must pass through the hands of the bookkeeper. 43. While the bookkeeper has so many duties, they are not as complex as those handled by the accountant. 44. In other words, the business is operating with the aim of making a profit and growing in value. 45. Another principle that guides accountancy states that all transactions must be recorded in the same currency. 46. The other principle that guides accounting requires that all financial reports show results over a distinct period. Financial reports are not prepared in a vacuum. 47. A business chooses the frequency of reporting in a year in a bid to monitor its performances. 48. It states that the cost of an item does not change in financial reporting, the time of reporting withstanding. 49. Every transaction is recorded as it is at the time of the first operation. 50. Do not just provide financial statements without providing explanatory notes for items or figures that may not be understandable to all interested parties. 51. Every counting period should give room for the transactions to occur in the following accounting periods. 52. There are two methods of bookkeeping, the accrual and the cash method. 53. In the cash method, transactions are recorded once money changes hands, while in the accrual method, transactions can be recorded before money changes hands. 54. However, the cash method will only recognize this method after you have paid for the good. 55. The other principle of accounting is that revenue should be reported when it is earned and not when it is received. 56. In this method, all transactions are deemed complete once they happen, regardless of whether money has been received or not. 57. In most cases, the accountants are expected to deal with the error in favor of the company as an entity they represent. 58. This principle states that, if there is more than one way of recording a transaction, liabilities and expenses should be recorded first and gains and revenues recorded later. This principle aims at protecting businesses from excess taxation due to poor record keeping. 59. This principle ensures that businesses do not suffer losses due to delayed entries that may end up being forgotten. 60. Financial statements are summarized information that is easy to interpret. 61. In other words, if the statements do not follow the set accounting principles, they may not be admissible in court in case of a legal battle. 62. If you are running a business, your financial records will determine the amount of taxes you pay, the type of business partners you bring on board, and your credit worth, among other factors. 63. There are three main financial statements: the balance sheet, the income statement, and the cash flow statement. 64. The balance sheet provides an overview of the assets and liabilities of the company. 65. The income statement, on the other hand, focuses on the revenues and expenses of a company. 66. The balance sheet helps you gauge the net worth of your business, while the income statement helps you gauge the current performance of the business in terms of profits. The income statement will help you determine the net income of the business after deducting key expenses and taxes. 67. We will then look at the cash flow statement, which will help us measure how the company generates funds to pay its debts. The cash flow statement mainly focuses on operational costs and expenses. This statement tries to gauge the financial position of the company and the ability of the business to continue. 68. It provides an overview of a company's assets, liabilities, and owner's equity. 69. When we prepare the balance sheet, the aim is to recognize the growth of the business and determine its net worth. 70. However, the business's assets are either acquired from cash invested by the owner or cash borrowed. 71. In other words, the cash invested by the owner at the start of the business represents the owner's equity, and cash borrowed represents liabilities. 72. While the balance sheet is prepared in a snapshot of time, the income statement is prepared over a period of time. 73. The formula for the income statement states that net income equals revenue minus expenses. 74. It is the general ledger that will record all your transactions, expenses and revenues, which are needed to determine the net income of the profit. 75. When preparing the income sheet, you must first classify your revenue and expenses. 76. This refers to the revenue obtained from the main business activity, such as selling cars in the example above. 77. Revenues can also be collected from the sale of long-term assets such as land or vehicles. All these types of revenue are accounted for in the income statement. 78. Primary expenses include those that directly lead to the revenue generated. The primary expenses include the cost of goods sold and operational costs. 79. The document is mainly prepared as a complementary addition to the income statement and the balance sheet. 80. The information provided in the cash flow statement is mainly used by investors, especially potential partners. It provides information on whether the business is in a position to pay its debts and continue operating. 81. The financing activities include the sources of cash from investors, such as other companies or from banks. 82. The portion of the company owned by the founder of business on the day of starting is the capital invested. 83. Owner's equity equals owner's equity brought forward plus retained earnings. 84. The statement of owner's equity mainly depends on what happens in the income statement. 85. At the same time, revenues will increase the capital. 86. You can see that if the expenses are more than revenue, the income is likely to be negative. 87. Without the balance sheet, it would be impossible for the company owners and other parties to know its net worth, its liabilities, and, as a result, the future of the business. 88. The other importance of income statements is that they help evaluate the past performance of the company. 89. If you do not have credible financial statements to show the performance of your business, you may not be able to get funding even if you apply. 90. The statement of cash flow helps show the strength of a business and its ability to finance debts. 91. If you do not provide accurate statements about your business's performance, chances are that your business will not be in good terms with lenders. 92. The company's worth will only grow if the business is making profits and retaining them. 93. If you are a shareholder, you want to invest in a business that is making profits and is showing prospects of growth for the future. 94. The income statement and the balance sheet will help you know if the company is on an upward growth trend or on a downward spiral. 95. The income statement and the statement of cash flow are very vital for creditors and debtors. 96. If a business has more current debts than current assets, it means that it lacks operating capital. In other words, it might not be able to meet its short-term liabilities. 97. Such information by companies helps employees plan for their future with the current employer. 98. The government uses the provided financial records to arrive at the decision of how much tax business will pay. 99. Every company is required to audit its finances, verify the information, and make it readily available for government audits. This helps to ensure that there is transparency. 100. They need the information to determine the liquidity of the company, profitability, and determine cash flows. 101. Competitors and brands that are similar to yours will try to gain insight into your financial information. 102. If the company keeps on making losses, an employee may choose to take off before they are left jobless. 103. As already mentioned, you will not be able to secure lending for your business unless you have the proper financial statements. 104. All businesses undergo ratings at some point. The ratings determine the success of a business in terms of its creditworthiness. 105. Suppliers mainly use financial statements to determine whether a client is the right fit for a business corporation. 106. They must prove that a company is making sufficient money before demanding a pay rise and other perks. 107. Although the trial balance is not classified as a major financial statement, it is the basis for preparing all the financial statements. 108. The entire process of accounting starts with a bookkeeper recording all transactions in specialty accounts. Once the transactions accumulate, they are summarized and recorded in the general ledger. 109. In the simplest terms possible, the trial balance lists the closing balances of credit and debit transactions over a given trading period. 110. In the simplest terms possible, the trial balance lists the closing balances of credit and debit transactions over a given trading period. 111. It can only be funded by money borrowed, liability, money earned, revenue, or money invested, owner's equity/capital. 112. In the end, total, the credit balances, and the debit balances. They should be equal. 113. If the debits and credits are not equal, there are chances that there are some errors in the accounting or bookkeeping process. 114. If you cannot balance the accounts, errors must be tracked back to the root. 115. The trial balance cannot prove that all transactions have been recorded. 116. Gross profit equals gross revenue, direct costs. 117. Gross margin equals gross profit/gross revenue. 118. The gross margin indicates the financial stability of the business. 119. However, a low gross margin might mean that you need to change some aspects of your operations to reduce expenses or increase revenue. 120. Operational costs are the normal daily expenses of a business, such as rent, electricity, etc. 121. Through day-to-day operations, a business is likely to lose some value from its assets. 122. Net profit/loss equals EBT, indirect expenses. 123. For this reason, it is necessary to prepare the income statement before you think about preparing the balance sheet. 124. You must first calculate your owner's equity to be able to balance your balance sheet. 125. The date you choose is usually referred to as the reporting date. 126. For those who prepare quarterly, they have to prepare 4 balance sheets in a year. 127. This means that your general ledger should contain all the information you need to prepare your balance sheet. 128. The items to include among the current assets are cash and cash equivalents, accounts receivable, marketable securities, inventory, and other current assets. Under the long-term assets section, you may list items such as company property, long-term market securities, goodwill, etc. 129. The items to include among current liabilities are accrued expenses, accounts payable, deferred revenue, the current value of long-term loans, etc. Under the long-term liabilities section, you can include items such as deferred revenue, long-term lease obligations, long-term liabilities, among others. 130. When preparing the statement of cash flows, we divide the template into 3 sections. This is because the statement of cash flows is divided into cash flows from investing activities, financing activities, and operation activities. 131. Operating activities cash flow. This refers to the money that the business spends on running day-to-day operations. 132. Investing activities cash flow. This refers to the money earned or spent from market securities or long-term assets. 133. In simple terms, the money spent or earned from other investment activities apart from day-to-day business operations fall under this category. 134. At the same time, owners injecting capital or borrowing money from lenders can also fall under investing activities. 135. Cash flows from operations are easy to gather, given that all the information is already available in your profit and loss statement. 136. In the simplest terms, retained earnings are a portion of the earnings that the company does not distribute to shareholders. 137. The owner's equity of any company is the portion of the company that can be claimed by the owners. 138. At the end of the day, all the information provided in the financial statements should add value to your business. 139. Just by comparing 2 balance sheets prepared in consecutive periods, you can tell whether your company assets are growing or declining. 140. For any business, the financial strength of the company is measured by the value of assets and owner's equity. 141. Your business has more liabilities than assets and owner's equity. Chances are that your business is very unstable financially. 142. For instance, you may realize that your company has more liabilities than assets and start thinking that it is headed downhill. In reality, some business models can support high debts as long as they remain operational. 143. In reality, some business models can support high debts as long as they remain operational. 144. If your stake in the company is less than your debts, it becomes a high risk since even if the business were to end at any time, the company might not be able to pay its debts accordingly. 145. If the company has a high debt-to-equity ratio, it shows that the company relies on debts to purchase its assets. 146. For different business models, the debt-to-equity ratio allowed varies. 147. In some businesses, a high debt-to-equity ratio is okay. 148. However, if the debt-to-equity ratio remains high, yet the business operations are not expanding, the business is likely to topple. 149. At the end of the day, if you are borrowing to increase operations, make more money, and grow the business, you are on the right track. 150. On the other hand, if the debt-to-equity ratio is high, and you happen to have more long-term liabilities, chances are that the business is at high risk. 151. The working capital ratio is simply the difference between your current assets and current liabilities. 152. If your business has a high working capital ratio, it means that your business can run smoothly in the short run. 153. However, a business that relies on borrowed funds to run the day-to-day operations may get stuck at any moment. 154. This ratio is the measure of a company's liquidity. It refers to the differences between current operating assets and current operating liabilities. 155. A company has a positive operating capital, it has the potential to grow. 156. At the end of the day, having more liabilities may also mean that your company is spending most of the earnings to pay debts. 157. You can review your assets and liabilities as compared to the start of your business. You will determine the rate of growth of the business over the years. 158. First, most investors and other interested parties will not associate with any business that is not making sales. 159. Even if the products being sold have a very small profit margin, more sales will lead to more profits in the long run. 160. The longer a business operates blindly, the more likely the company will make losses. 161. Business might have a slim net profit, yet it has a huge gross profit. 162. Such differences will help you make changes that will help reduce operational costs and increase the net income of the business. 163. Some operational expenses may make the cost of production too high, making it impossible for the company to make profits. 164. Most financial analysts assume that management exercises a great deal of control over these expenses. 165. If the company is struggling to earn an income, it is the duty of the managers to ensure that necessary operational expenses are cut down. 166. The company is struggling to earn an income, it is the duty of the managers to ensure that necessary operational expenses are cut down. 167. In other words, the operating income of a business refers to the income before interest and taxes. 168. If you are making an operating income that is substantial to cover all the operations and cost of goods sold, your business is in a good position. 169. The operating income mainly represents the earnings of the company before operating expenses such as interest, insurance, and taxes have been charged. 170. The income statement will help you calculate the income tax payable at the end of the trading period. 171. The expenses can exceed the income of your business, you will end up with a net loss. 172. The net income is usually used to pay dividends to preferred shareholders. 173. However, the term comprehensive income is only used by large corporations that operate internationally. 174. Comprehensive income is the net income of business adjusted for foreign currency exchange rates and minimum pension liability adjustments, among other factors. 175. Investors who may be interested in purchasing the stock of a company may want to know about the portion of the business's assets that are acquired by loans. 176. In other words, it is a company that can finance its assets without necessarily depending on loans. 177. However, if its owner's equity value starts falling, chances are that the business will end up having more debts than it can settle and consequently topple. 178. As we have already mentioned, the owner's capital represents the portion of the company that directly belongs to you as the owner. 179. The value of the owner's equity versus the liabilities of a company can tell you whether you need to invest in or borrow more. 180. It is important to ensure that your equity-to-debt ratio does not go over 40%. 181. With that said, if your business can run well without the need to borrow, keep on managing it until it is absolutely necessary to bring in external sources of income. 182. Your business is making profits, but none is retained, it means that the business will not grow. 183. From our explanation in the first chapter, the owner's equity is simply the capital invested by the owners at the start of the business. 184. Assets lose their value as time goes by. 185. the statement of cash flow simply shows where revenues are coming from and how the money of the business is being invested. 186. However, the cash flow statement offers a comprehensive analysis of all the sources of income, including investing and financing activities. 187. This is because all businesses are required to use the accrual method of accounting. In the accrual method of accounting, all transactions are deemed complete once they take place and not when the money is paid. 188. Do not be quick to pay your supplier before your customers pay for their goods. 189. Failure to keep the accounts receivable. 190. Every business will have customers who purchase on credit. If you fail to maintain the accounts receivable, chances are that you will end up losing too much money due to failure in tracking down some cash. 191. The accrual method of accounting requires that all transactions be recorded as soon as they happen. In simple terms, money doesn't have to change hands before a transaction is deemed complete. 192. The accountant must supervise the work done by the bookkeeper and provide guidance. 193. Today, most companies use automated accounting software. The automation helps in recording transactions in real time to reduce the chances of fraud. 194. Failure to keep documents that prove the occurrence of transactions. 195. For instance, you will need a bank slip to prove that cash was deposited or withdrawn over the counter. 196. Failure to consolidate subsidiary books with the general ledger. 197. Failure to prepare the trial balance. 198. Accounting software is as important as the accountant. 199. Accounting software is particularly important when dealing with bookkeeping. 200. Cash flow tracking is the backbone. 201. When managing your cash flow, you should watch the timing of the money coming and going out. 202. Understand your cost of goods sold. 203. Start by determining the fixed expenses of the business. These are business expenses that are constant, whether your business is operational or not. 204. For all businesses, there is a level of production and sales that lead to profitability. You must target the sales that lead to profitability in the long run. 205. One of the most basic needs of accounting is to determine the profits and, consequently, the tax payable during a given trading period. 206. Exclusion of financial transactions. Any prudent business manager will not only focus on financial statements but also review the ledger book and other books of entry. 207. Lack of correlation to previous financial statements. 208. For instance, if the financial records for the trading period ending December 31, 2019 are completely different from those prepared in June 2019, chances are that the figures are being cooked. 209. Lack of source documents to prove transactions. 210. The accountants may make adjustments to the true figures of your accounts and siphon money out of your business if you don't make a critical analysis of the financial statements. 211. For instance, if you realize that your debt-to-equity ratio has increased yet you have not borrowed more, you are probably losing money to the accountants. 212. While the other figures on the financial statements may have significant differences as compared to the subsequent accounting period, financial ratios do not change much. 213. In accounting, errors can occur whether made intentionally or by mistake. 214. Relying on documents such as the trial balance or the balance sheet to determine the accuracy of your financial records is not the best approach. These documents can only help you prove a few facts, but will not show some serious errors. 215. Some auditors may collude with accountants to steal from the company. 216. Assets. Assets are items of value that are owned by the company. 217. Liabilities. These are items that decrease the net worth of the business. 218. Equities. These refer to cash or cash equivalents that are used to represent the ownership of the company. 219. Revenue represents all the money that is earned by a business over a given trading period. 220. Expenses represent the ways a company uses its funds. 221. The truth is that business managers and owners need the statements more. 222. The balance sheet. This is the financial statement that provides a snapshot of a company's net worth at a given point in time. 223. It shows the income and expenses of a company. 224. The cash flow statement. Third most important financial statement is the cash flow statement. It shows the sources of money for business and how the money of the business is spent. 225. However, if I were to choose one as a business manager, I would go with the income statement. 226. The income statement provides a true picture of the current operations of a business. 227. For instance, suppliers need to look at the statement of cash flows before they supply goods to a business. If a company has sufficient amounts of money in circulation, investors are confident that it can pay its debts. 228. A company that has a future should have more assets and fewer debts. 229. The bookkeeper cannot prepare financial statements since bookkeepers are not certified accountants.